Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Jered Sturm with SNS Management. Welcome to the podcast show, Jered. Thank you for taking time today.
Yeah, thank you for having me. I'm excited to share my story with your audience and see what kind of value I can provide.
Incredible. So Jered has a very awesome story wherein he started as a maintenance technician 15 years ago, during his residential property experiences, and slowly but surely he has, sort of leaped that ladder and, got into bigger, better properties, from single properties to, duplexes, triplexes. Today, they own a lot bigger portfolio of multiple apartment units. Their portfolio right now in Cincinnati, Ohio is well above $30 million worth of assets. So it is an incredible growth, and I'm excited to hear about his journey. So in your words, Jered, kind of give us some background about, how did your journey started and, where you are at with your company today.
Yeah, sure thing. Thanks. I think our journey is a little bit unique for where we're at currently. So a lot of the multifamily syndicators that I speak with are those who come from an institutional background. They'll work at a large firm or potentially have an MBA and see an opportunity in real estate investment. My background, my partner's background, is more of a organic grassroots growth. So
Sure. Mm-hmm.
We started as a maintenance technician. What that means is I was the guy out there fixing toilets, servicing rental properties for a local landlord in the Cincinnati, Ohio market. I used that skill set with my brother to start a construction company, just doing kitchens, bathrooms, additions for what started to be friends and family and grew into others.
Sure. Mm-hmm.
And we took that money, saved it up, and when the real estate market crashed in 2008, we kind of looked around and said, look how inexpensive these houses are. Why not use the money we've saved up to start buying those? And while there wasn't a lot of money, we did substitute our lack of capital with our sweat equity and skill set in construction. So we were buying the inexpensive house, fixing it up, renting it out, stripping the equity, and moving on to the next one. And that went from single families to duplexes to 4s to 10s to 40s to 100s. And so I whizzed through 15 years there, but that is how we have gotten to this point, is just doing the same model that we started with, is forcing appreciation through our background in construction and then stripping the equity to grow the company. And so the model really hasn't changed. It's just grown exponentially.
Incredible. And that, thank you for sharing that, Jered. And the nice thing about that story also, Jered, is that you get to experience, what the work is about on the ground and see what it takes to kind of do the work. See the vintage of the buildings and stuff like that. And your point about someone coming from a private equity background or a professional MBA and things like that, they are more, investment driven in terms of the numbers, the professional sort of the underwriting, and kind of seeing the yield and the delta and things like that, right? But I can completely relate to your story where, as viewers may recall, I have a strong single family background into vintage property and, doing all the distress repositions and, pretty much renting them one house at a time and kind of scaling up the portfolio. So I totally understand where you're coming from. Can I give us a sense, Jered, about when you started doing this, when was that sort of belief came to you that, yes, I'm doing this, but I can see sort of the higher or the bigger picture of building a portfolio and kind of taking this from, sort of a path where you are a maintenance person, but you want to be a investor. What was that light bulb moment like?
I don't remember.
Uh-huh.
That's the honest answer. So, as you gave in my background, it's been 15 years, but if anyone is watching this on video, I'm only 30 now. So I bought my first property in
Awesome.
2018. If you're doing the math, that means I bought my first one when I was 18.
Sure.
And so I don't remember a specific moment,
Sure.
but I was a maintenance technician while I was in high school.
Mhm.
And something I do remember that will potentially somewhat answer your story is my senior year of high school, my English teacher made us write letters to ourselves that
Mhm.
she would deliver 12 months later. So like
Awesome.
on
Mhm.
our graduation. And in that letter, I am not a writer by any means. And in that letter, all I wrote was, if you don't own 5 houses by now, you suck. And so at some point, I guess in high school, I decided I wanted to be a landlord and I wanted to own rental properties. And I'm guessing it was just because I had worked in the industry as a maintenance technician. I understood it. And so I also understood being where the top of the food chain in that industry is, and it's at the ownership level.
Awesome. Awesome. Boy, I am super pumped because you are a young superstar. I mean, wow, you bought at such an early age and you are just at 30 now with so many units and such a big portfolio with full management company and so many apartments, units under your management. So definitely kudos to you, So Jered, explain us like some of your prior experiences, like for example you were fixing up the houses, the vintage and things like that. You mentioned the word about equity stripping, which essentially means that you're probably refinancing and using the proceeds to go to bigger and better units and things like that. So kind of give us a sense of like today you are as you described SNS management with three 2 of your other partners. So how did your group came about, and what were your like early experiences like when you were fixing up the houses and things like that?
Okay. Well, it's come a long way. So it started with just me and my brother.
Mhm.
So we were both maintenance techs for the same local landlord. And
Mhm.
then we both went out and started our construction company together. And then both started this real estate company together. And we built that to about 25 units on our own,
Mhm.
and realized we did have a weakness. So like it was
Sure.
the back end of the business.
Mhm.
And so what we did was we started looking at ways to mitigate that or help us in that weakness. And we found our third partner at that time, and his name is Coleman.
Sure.
Coleman came on. He has a master's degree in accounting from BYU. He worked at larger multi-billion-dollar real estate firms doing their investor reporting as well as some of their analysis. And so we brought him on as an equity partner and have been growing ever since
Mhm.
because we complement each other well. And
Sure.
so that's been great. But as far as the early experiences that you ask about, it was a lot of fun. I mean, it was a lot of fun working with my brother every day. Just it was similar to our childhood, like building tree houses.
Sure. Mhm.
You go into these houses, work together, see
Mhm.
something, go from a piece of junk to a great place to live.
Mhm.
So a lot of fun there. And as far as stripping the equity goes and early experiences, I'll never forget it. We had to buy our first 6 houses cash because, as I told you in the beginning of our stories, it was 2008. Lending climate wasn't very
Sure.
good. I was
Mhm.
18 years old. Nobody wanted to lend to a hopeful real estate investor who was 18
Sure.
years old. So we did our first 6 cash. And then after maybe took us 2 years to get to 6, I think. And at that point, we found a bank that would give us a blanket cash out refinance at 60% loan to value. And
Wow.
I'll never
Mhm.
forget that day because the check that came off of that refinance from a fully cash purchase portfolio was like, oh my gosh, this works.
Sure.
What we've
Mhm.
been doing for 2 years and not getting paid for is working. And so then we took that, nice size check and just bought 6 more and just kept it rolling. So that was our early experiences, and that's kind of how our partnership came to be.
Awesome. Now you described your other partner, which is Coleman, you said. Did you meet him or you know him already? Was he like a family friend and things like that? Because trying to establish and finding out that professional sort of person and, filling that key gap. What was that like? Was that through like maybe perhaps a real estate RIA or a family friend? How did that come about?
No, we did not know Coleman. So we met him at a real estate networking group that I actually put together. It was just a lunch with, I think, 8 to 10 people in the Cincinnati market. And at the time, Coleman was working at a large firm that does real estate investment, but he didn't own any of his own. But he we got along with Coleman well. And one thing he asked was, I like how you guys run your company. I would like to learn how to manage properties. Could I work for you for free to soak up some knowledge and then go do my own thing? And after about a year of us working together, we realized this was a really good fit. And rather than him work for free or work for a salary, at the time, we just didn't have the revenue to support a salary that Coleman would demand. And so we struck an equity balance that we were really happy with. And so it was just his initiative to learn the industry and his offer to work for free. And then his value that he provided to the company that, we saw as a huge value and then have just grown on since then. So that's been, many years now.
Awesome. That's incredible sort of marriage, so to speak, and 3 partners coming together and different strengths and kind of moving the company forward. Now, if you can, Jered, give us a quick snapshot of who leads which area in your company. Like you are 3 partners, obviously, with the scale of company that you have. Can you maybe tell us like who leads which size of the business now?
Yeah, I mean, the quickest, easiest way to explain it would be those familiar with corporate structure I would be CEO, my brother is COO, and then my partner Coleman is CFO.
Sure.
And so what that really means to us, the titles are great, but what it means is I push the company forward. My brother cleans up the mess that creates. So every time you grow, it creates complexity, and then he tries to simplify that down through systems and processes. And then my partner Coleman handles the back end of the business and handles the money. So that's kind of how we delegate those responsibilities at a very summarized level.
Sure. And drilling a little bit further there, Jered, how is that organized in terms of your org chart? Like, you have your own property management company and things like that. So I would assume that obviously is your brother's responsibility as far as operations fall and things like that. What does that structure look like in terms of, within the property management, like how much staff you have, or perhaps if there are any, freelancers or W-2 or perhaps any subcontractors, that kind of thing.
Yeah. And as you'll know, even though we have 450 units, that's still relatively small. And so org charts are important and knowing your responsibilities are important, but at our size, as an owner, you wear multiple hats. And so we do our best to strike that balance and strike that organizational chart, but we all jump in where is needed. Yes, my brother oversees the operations, so he's kind of at the top of that property management, but also Coleman as CFO oversees a lot of that too. He's watching the rents and the revenues and all of those things and how to project that out and create budgets and those types of things. I'm looking at which properties are we buying in the future, which properties do we want to manage since we manage our own. So we're all collaborating, but below the ownership level, it's a pretty standard org chart. There's property managers that oversee. For us, it's usually about a 300 unit clump. So that could be 300 units made up of 4 properties. It could be 300 units made up of 10 properties. It's more based on geographical locations and how close they are. 300 units are serviced by 1 property manager, 1 leasing agent, 2 maintenance, and 1 cleaner. So that's kind of the organizational chart that we can repeat as we scale.
I see. I see. And I assume your company is now looking to purchase more similar properties as you grow. Would that be a correct statement?
We are looking to purchase more, and I would say similar, yes, but larger for sure. So um, our background was we did a lot with our own capital up until a few years ago, and then we've ventured into the syndication model, which has opened up opportunities to buy slightly larger. And that's very intentional because we see the operational efficiency of larger, the economies of scale of larger. And so now we're looking at 100 to 300 unit apartment communities here in the Cincinnati market. And we do that by raising money from passive investors. And so similar, but yes, definitely scaling up on the size of the asset.
Sure. Thank you for sharing that. And Jered, explain us, like, obviously you shared that property management gives you an edge in terms of, whether it's the ease of operations or the cost control and things like that. Can you describe in your words in terms of, like, what is it like in terms of having the control and using your property management to see that yes, you have a lot more advantage over other operators? Can you maybe break it down how you see it through your own eyes?
Yeah, and I have a great story for that because when we hit about 40 units, it got to a point where we thought this is getting pretty challenging. We're going to bring on third-party management to oversee the management arm of our company. We'll focus on construction and acquisitions. And how we decided to approach that was from the perspective of the resident or tenant, because ultimately they are our customers. And so what we did was we looked in our market in Cincinnati, Ohio, at listings of similar properties,
Mm-hmm.
and we called them to tour them like we were going to rent them.
Mm-hmm.
And so we wanted to see kind of boots on the ground, how were management companies handling similar assets? Were they returning calls to tenants? Were they following fair housing laws during showings? Were they being responsive? What were their minimum requirements? Those types of things from the perspective of the customer.
Sure.
And the results were awful. And so what happened there was the results were so bad, we were not comfortable giving up the very important role of property management of our investments and assets to these companies that were out there servicing them. And at that point, we made the decision to vertically integrate, build out our management company, build the systems around our portfolio that we wanted to see. And I've always said this, is property management is the least fun, most important part of the investment. Like it can make a okay deal into a great one. It could take a great deal and run it into the ground. And so I like having that control because I saw how it is mismanaged, and we made that decision a long time ago to vertically integrate and support our investments through the operations. And I highlight to our investors or anyone we talk to is what we're good at as a company is being operators. And so
Sure.
like that creates the success that we've had is operationally making these properties as efficient as we possibly can. And so I'm really glad, many years ago we made that decision to vertically integrate, because forcing the appreciation, controlling the value of your investment is so incredibly profitable, but also very useful when it comes to the investment arm of the business.
Sure, sure. No, I totally agree with you. And I mean, the culture, sort of the experience you give out to your, prospective customers or perhaps even your existing tenants and things like that, it goes a long way. And I think once you have a property management in-house, like I shared with you before, that we have the similar style, we do all our management internal, but just the whole culture, the experience is very different, that you are in a more customer service mode, trying to help people rather than just a typical management company who probably doesn't have that much attachment towards just helping the customers. There, even a lot of times, as you know, the employees are just there clocking in and out and not paying that much attention to all the different legs of the business, right? So good. So Jered, moving on, how was your first sort of syndication like? Can you maybe kind of give us a sense of how many units, deals, like sort of the financials and how you raise the money and things like that?
Sure. Yeah, the first one was 93 units, and Cincinnati, Ohio, 93 units. I found the deal through cold calling. So in Cincinnati, Ohio, specifically Hamilton County, all rental property owners of, I believe, 4 or more units have to register their rental property.
Mm-hmm.
Occasionally, some of the older landlords or mom or pop running businesses will write down when they do that, they'll write down their personal phone number,
Sure.
registration form, which is public record.
Mm-hmm.
So I will take that data, put it into a spreadsheet, and at the time I was cold calling those owners to see if they could sell. And so this was a property I knew I liked, and I had called him for 3 years, and finally this, 3 years every single month. So on the 37th month, he was ready to sell. We purchased that property for $2.2 million, which
wow,
per unit price was a really good price. But this was a very heavy lift on a renovation and value add.
Mm-hmm.
He had no financials whatsoever, none.
Mm-hmm.
No tax returns.
Wow.
I think he was dodging the government on that one. So
Sure.
We had to find a lender who was comfortable with that. And so what we ended up doing was going to a lender that had lent to us on flipping of houses when we were doing construction and just trying to make some extra capital. And so they knew we could handle the workload. They lent to us. We did the property. After 2 years, we had repositioned it, and complete turnaround. We got thank you letters from the chief of police, and the city was very grateful for what we had done. The property actually had a successful exit recently. By exit, I mean refinance. The property appraised at $5.2 million. We were able to strip out the equity, same business model. And then we take that and we roll it into the next deal. And so taking a property that was beat down, purchased at in the 2 millions, and then refinanced in a valuation of 5 is very, very fulfilling. So not only financially fulfilling, but fulfilling for the impact it had on the community.
Sure. No, and that's an incredible story, actually, and it's very interesting. We can kind of piecemeal it in several ways as I listen to you, Jered, that here you are as an experienced operator, as a technician who has seen, like once you kind of walk through the building, you'll understand the scope of work and the seriousness that some of these heavier lift assets it can take, right? But then, you have some other newbies who will come, hey, I have some mentor behind my back. I think I can do it. And all they know is, yes, it needs a heavier lift, and perhaps, they'll have some property condition assessments and stuff. But this is where the experience comes in, is the exact, the figures that, hey, the plumbing, the electric, the general interior conditions, whether it's roofing, siding, all of that practical experience. Can you maybe talk about specifically, like, what were some of the heavier lift items you did, and, why it was the right fit for you and not perhaps someone else?
Yeah, I think it's because you can see through the scary things. So like this property, I walked up to it and I can see, yes, it has broken windows. Yes, the resident base is really, really rough. But I'm looking at it and I'm like, this thing has great bones.
Sure.
And so to those mechanical aspects that you speak of, the exterior facade was brick. The roofs had been replaced, but,
Band-aids over band-aids.
Yeah, band-aids over band-aids, but we could see exactly what it needed, and I could see that it could be brought back. And really the core problem was the management of the asset, not the asset itself. And so when I say heavy lift, it was replacing all the windows, doing the parking lots, doing all of the interior cosmetics, which would be flooring, walls, cabinets, bathrooms, those types of things. But this is all stuff we've done for many, many years. And so it's just, instead of doing one of them, you're doing 93 of them. And so, we were able to turn that around pretty quickly and make a really big impact. But part of part of the syndication, the first syndication that I didn't answer, is how we raised the capital. And so I had a close friend who I had met and said, if you ever plan to raise money, I would be interested. And so I put together the marketing package, planning to raise from lots of investors, and I sent it to him and I said, I'd like your feedback before I put this out. Give me your feedback. And ultimately his answer was, if you put in half the money, I'll put in the rest. And so the first syndication was not, while it was a legitimate syndication, it wasn't very, it didn't have the same stressors of raising money from large groups of investors, because he also saw the opportunity in it and scooped it up and took it all. So later we ended up doing more syndications where we have lots of investors in as a pool, but that was the first official syndication and did have a successful exit. So it's a great story.
Sure. Awesome. Can you maybe describe, Jered, like what were some of the like sort of the intricate details about the rehab, whether it was exterior, interior, like, could you maybe go into some more detail on that?
I guess so. Interior cosmetic upgrades is something we do on all of our properties.
Sure.
So, that's kind of our bread and butter.
So was that mostly like replacement of doors, cabinets, perhaps changing the entire bathrooms? Was it that dramatic?
Yes. Yeah. And so that for us, I mean, we've gotten it down to a science. The first syndication obviously was a learning process. We were already pretty good at it, but now where we're at is very, very good. So we are pretty heavy on analytics, tracking KPIs. And I know now that our typical turnover with a full cosmetic, which would be kitchen, bathroom, flooring, walls, doors, hardwares, light fixtures, is averaging about 2.4 days for a 5-man crew. And so like, we know what that cost would be, and then we can project it out onto future projects. But something that I've learned, like, I guess a tip you didn't ask, but we installed vinyl life-proof flooring in all of our apartments and all the living spaces rather than carpet. And so we're renovating to own these assets for long term. And so when we go in, we're doing everything that we can for the long-term operation of these assets, because we're not just the construction company, but we're the construction company and the owner.
Sure.
And so our scope of work caters to preventative maintenance and long-term, suppression of capital expenditures.
Sure. That makes complete sense. And how was the exterior improvements? Was it just parking lots, any building paintings and things like that, or was it any dedicated leasing office or any landscaping that you had to spruce up about that, Jered?
Yeah, there was a leasing office. The previous ownership was using it as a storage room for all the old mattresses that piled up in the dumpsters. So we cleaned that up and converted it back into a leasing office. We did do some of the roofs. Some had already been done in an insurance claim. I'd say one of the larger projects that operationally was challenging was replacing the 480 windows.
Wow.
So that was subcontracted out, but the logistics of entering into 93 apartments, ripping out their windows and reinstalling new windows is a challenge in itself.
Sure.
So that was a big exterior upgrade and made a huge improvement on the curb appeal, because these were 1970s single pane aluminum windows.
Sure.
And we did do parking lots. They were just pothole ridden. We ripped them out and replaced them, restriped them. Landscaping upgrade was pretty typical. Just where it was mud, we planted grass. Where there should be bushes, we put mulch and bushes. Nothing extravagant. This is absolutely a C-class property. And so one of the things that we've learned through that organic growth and through our background in construction is not to over improve too. So we know what our customer wants and what they demand and what reaps higher rents and what doesn't. And so, we're not putting in garden beds full of beautiful flowers because it does not push the rents at all in this product.
Sure.
So, that I guess that kind of highlights the exterior upgrades. Did I answer your question?
You did. And I guess one piece we can talk about also, Jered, here is that if there was any other newbie, doing such a large, reposition, would you think that they would be successful, or what is your take on some of these heavy lift projects, perhaps, some newer syndicators doing some of these things?
It depends. So like, I think it depends. Like, someone who is new, and even lacks the experience that we were fortunate to have, can figure it out if they have the drive and motivation, but by no means was it easy.
Sure.
And so there was really challenging days. I mean, in the first month, I was definitely questioning what we had done, which is, because in the first month, we had 2 overdoses from heroin. We had a fire in the building.
Oh boy.
And so like there was times where you feel overwhelmed, but no, I think it all depends on the person. I don't think you need any certain set of experiences or any certain background or degree or anything to accomplish challenging things, but you do need motivation and mindset that you're going to push through and figure out the solution. And so I think any newbie could do it, but I don't want to mislead and say it's easy for any newbie to do it.
Sure. And that's where the, on the ground experience comes in. So I couldn't, agree with you there, Jered. Now, talking about, your company growth, Jered, and how you have scaled up, different times call for different expertise and different level of resources and things like that. I mean, technically we call them like inflection points, of your company. Can you maybe share as to, how things have changed? Like when you started, you stated that, yes, you brought in your partners and things like that. But now as you are growing and raising, more capital to perhaps do more bigger deals, what are some of the things that have changed in your journey?
Well, I think every day there's something changing. Just as you're running a business, the speed of which business moves right now, like constantly something is changing, a new policy or procedure. And so minor tweaks are always being made, but those big inflection points that you refer to, definitely switching from using our own capital to raising money from investors was a big change in our business. But I would also, I guess, even say it is a completely additional business. It is a whole nother arm of our business. So it's not just if you're good at renovations and good at property management, you should be raising money from other people, because it is a completely separate business that is an arm of what we have built as a portfolio. But you have to have different skill sets. Like my partner, he has an institutional background in reporting to investors. And so if I were to have tried to take that on with my construction background, I would have been producing a Microsoft Word document that said, we did great, here's your check. And maybe I could have made some money, but accredited investors demand a higher level of reporting and deserve a higher level of reporting. And so an inflection point is definitely switching to add on that additional arm of our business, because it is completely separate. It is a whole new business.
Sure. Now, switching the discussion to, sort of the purchase of newer assets, where the market is, like what sort of assets you are targeting and things like that. Obviously we're going through pandemic as well. What are some of the things you're looking in your newer acquisitions? Are you like in terms of, like, let's say the returns and things like that? How are you shaping up your underwriting to kind of give the projected returns? What are you looking for?
Mm-hmm. Well, I would say our business has been very similar all the way through. And so even now, as we're growing, we're looking at larger assets, but it's the same model, right? Mm-hmm. So something that needs a value add, forced appreciation through construction. And so that is what we're still looking for. We're looking for larger assets. As far as a return goes, we look in the range of like 10 to 15% cash on cash return annualized. Mm-hmm. We do typically hold longer than most syndication sponsors. So we're long-term buy and hold investors, and long-term in the syndication model for us means 10 years.
Sure.
And so what that does, and the reason we focus on 10 years, is because it helps us fall back on our strengths and hedge any kind of downside. So we things like pandemic or economic recessions, we can hedge against those downsides by falling back on our ability to operate. And so we want 10 years and we want well-structured debt for those 10 years to be able to handle that. And so that's what we look for moving forward.
I see. Now, speaking of the pandemic and all the different stresses we have had on renters, like some have lost jobs or perhaps reduced hours and things like that. So when you're looking at new assets, Jered, can you maybe share What are your thoughts on some of the problems we are seeing in the sort of the gross monthly collections? And, obviously we know that the net operating income of the properties are going to sort of be, a little choppy, if that's the right word. How are you safeguarding yourself in terms of how you are going to evaluate some of these issues that have come up now?
Mm-hmm. We're very fortunate that here in the Cincinnati market and really the Midwest, I haven't, in the multifamily space, we haven't seen too much of an issue. So at the beginning of the pandemic, I was definitely concerned and wondering, how payments will be made. Obviously, time will tell as different financial aid and things dry up, and we'll see where that all plays out. But collections have been very strong in our market. Mm-hmm. Now, as far as how do you mitigate risk based on the pandemic or any kind of recession, what we do is in the offer we're making right now, if we get something under contract, we will have a collections contingency in there. Mm-hmm. And so we're confident in our ability to operate through this pandemic, but one of our concerns is, can the current ownership maintain the operations they have right now through the end of the contract, and how will that impact financing and things like that? Mm-hmm. And so we'll add in a collections contingency that we might not have had before the pandemic, just to say, here's where you're at, you have to maintain it. If you don't, we're going to, obviously renegotiate or reevaluate this project. So that's awesome. One way we've been changing it.
Awesome. Now, Jered, speaking of all your different partners and things like that, how are you looking for bigger projects moving forward? Are you looking for like sort of a B plus asset, or are you perhaps looking for other markets? Can you maybe share what are some of the things you're looking forward to in the midterm to perhaps later down the year or perhaps next year?
Yeah, same type of projects, kind of C to B class in the 1960s to 1990s assets, just larger. So 100 plus units is what we're acquiring, and they're really challenging to find right now. But the good thing is the life that I enjoy and the life that I desire is supported by the investments that I've already made thus far. So I don't have to purchase unless I find something that is a good acquisition. We're definitely not a firm that is buying for the sake of buying. Mm-hmm. If it takes us 2 years, it takes us 2 years. If it's next month, that's great too. But we're just looking for good opportunities that fall within our range of expertise. And so it would be in the Cincinnati market. I will tell you a story. When we shifted to the syndication model, we reached out to all of the people we thought would be interested in investing and asked them what they were looking for. About 50-50 split. Some said cash flow, just give me yield. The other side said wealth preservation and the potential for growth. And so what we did was, we know Cincinnati market really well. It's a very strong cash flow market. And at the time I said, like, there's not a lot of potential for growth. I'm kind of changing my opinion on that. But what we did was we started looking at other markets that would give us the potential for growth through economic fundamentals. And, my brother, who has a background in construction, his actual formal degree is real estate economics. And so we started looking at these other markets, and we decided on Atlanta, Georgia. And so we said, hey, we've built what we did in Cincinnati. Let's go do the same thing in Atlanta, Georgia. The way we know how to do it is boots on the ground. So we moved there. So we up and moved to Georgia, and we're trying to buy large apartment communities there. And it taught us a lot because it didn't work. And so we were there for 2 years, and it taught us that what we look for as investors is consistent, predictable cash flow, not speculative investing. And while I believe heavily in the economic fundamentals of Atlanta, people believed in them and were willing to pay for them to an extent that we were not. Mm-hmm. And so it taught us a lot about what we look for as investors. And we were trying to satisfy our investor pools once, but it really wasn't what we were good at. And so moving forward, I have a very strict focus on the Cincinnati, Ohio market, where we have full control and in a competitive advantage, because this is where we were born and raised and have spent 15 years in the industry. And then I'm just going to do the same thing we've always done. Look for properties that need value add components through property management and construction, and just do it at a larger scale.
Sure, sure. Thank you for that clarification. Now, some of the strengths also sometimes become your hindrances as well. And where I'm referring to, Jered, is that, the story that you shared now, right? That Atlanta market, yourself, owner and operator, and perhaps the model that perhaps belongs there is, lower cap rates, high returns, and probably a lot more on the speculative side, right? So one can always argue that, hey, this is where this is a growth market and it's not a typical cash flowing market, right? So are you perhaps proposing, Jared, that you more so like the cash flowing markets and perhaps not that much the high growth, low cap rate type of markets, and trying to pay the market rate and going up in the best and final and going up and up in your offer price, so that it almost starts to get speculative? Are you maybe indicating along those lines, Jared?
Yes. I mean, as an investor, I like consistent, predictable cash flow. And I think all investing has some level of speculation, right? So we rely on our skill sets and our experience to try to project out 10 years. To some degree, that is guessing and that is speculative in nature. But when you can reduce the amount of speculation that you're investing on, that's when I'm most comfortable. And so I tend to gravitate towards that consistent, predictable cash flow. And Cincinnati is a great market for it. We were just out chasing greener grass in Atlanta and realized we never bought anything in 2 years. We never bought a single thing. And we realized it was because it wasn't a fit for us. So you're right. It was just not fit for us. Not that it won't work, not that people who buy in Atlanta are wrong. It's just not a fit for our investment appetite.
Incredible. Thank you for those insights, Jared. Please share with the listeners, how they can kind of find you and perhaps learn more about your company and everything.
Sure. Yeah. So you mentioned SNS Management. That is our management company. But as I said, raising capital is kind of a completely separate business. We do that under SNS Capital Group. So that's 3 letters like Sam, Nancy, Sam, or Sturm, Nelson, Sturm. And SNScapitalgroup.com is our website. And there's a link there that if you just click contact us, we'll be able to get your email. And if you want to talk to me, you can put attention to Jered, and I'll be sure to respond and get back to anybody who has any additional questions about our company.
Incredible. Thank you for all your insights, Jered. It's been a pleasure knowing you and knowing the growth of your company. I hope we can, regroup again in future and learn a lot more things as well. So thank you for coming on.
You're welcome. Thank you for having me and letting me share my story.
Awesome.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.